Have you ever looked at the market headlines and felt like you're living in a totally different reality? Well, you're not going crazy. We are going to dive into one of the biggest economic puzzles out there right now, this great divide that is almost everyone scratching their heads.
Okay, let's just jump right in. On one hand, you've got the stock market, where the S&P 500 is knocking on the door of 7,000. We're talking all-time highs. It is a full-blown party on Wall Street. But then you look at Main Street, and wow, it's a completely different story. The Michigan Consumer Sentiment Index, which basically measures how regular people are feeling about the economy, just crashed to its lowest point in history.
So, the big question is, how can these two things be true at the same time? It really feels like the market is having some kind of hallucination, just completely disconnected from what's happening in the real world. In this explainer, we're going to peel back the layers of a really detailed institutional report to figure out what's really going on under the hood. To get started, let's just look at the raw data that's sending all these mixed signals. It's a picture of perfect confusion. Now, this is what's so fascinating. It's like the market has selective hearing. We've got high headline inflation at 3.3%, mostly thanks to a huge jump in gas prices. We have extreme geopolitical risk with Iran threatening to blockade the Strait of Hormuz. That's a big deal. And yet, the market seems to be completely ignoring all of that bad news. Instead, it's laser-focused on the good stuff, stable core inflation and cooling producer prices. It's taking those as a sign that everything is just fine. So what on earth is holding the market up? Well, if you ask pretty much anyone, they'll give you a one-word answer: AI. And that's the surface story, right? The one everyone knows. And this chart just says it all. It shows just how incredibly narrow this rally is. Almost all the gains in the S&P 500 are coming from just a tiny handful of big tech companies, the AI darlings like NVIDIA and Microsoft. They are single-handedly dragging the entire index kicking and screaming upwards, while pretty much everyone else, the other 493 companies, are just treading water. So the key takeaway here is pretty simple. This is not a sign of a healthy, broad market recovery. The report actually calls it an unhealthy tilt. It's a super fragile foundation where the fate of the entire market is basically resting on the shoulders of just a few giant stocks. But that AI story, as powerful as it is, it's not the whole picture. Not even close. To find the real hidden driver of this market, we have to look away from the headlines and deep into the plumbing of the financial system. And what we're finding there is a pretty serious liquidity crisis brewing just beneath the surface. Okay, first, we got to talk about something called the TGA, or the Treasury General Account. The easiest way to think about this is that it's the U.S. government's main checking account. So when the government collects taxes, the balance in this account goes up. And when that happens, it acts like a giant vacuum cleaner, just sucking cash right out of the private banking system. And as you can see right here, that vacuum has been working overtime. In just the last 3 months, the TGA balance has absolutely exploded, pulling over $700 billion of cash out of the market. The report calls this a fiscal quantitative tightening, and that's a fancy way of saying a massive drain on liquidity. Now, normally, the system has a cushion to handle something like this. It's called the RRP, or Reverse Repo Facility. This is where big financial institutions can park their extra cash overnight. You can just think of it as the financial system's emergency savings account. But here's the kicker. That emergency fund, which had over $2 trillion a year ago, is now down to just $16 billion. For all practical purposes, it is completely empty. The safety net is gone. So you have this combination, a huge cash drain from the TGA and an empty emergency fund in the RRP, and it's created an incredibly dangerous situation that the report calls the liquidity cliff. The system is basically running on fumes, with no cushion left to absorb any kind of shock. And this brings us to the biggest question of all. If there's this massive liquidity crisis happening behind the curtain, why on earth is the stock market still screaming to new all-time highs? The answer? Well, it has nothing to do with fundamentals or how optimistic investors are feeling. It is all about market mechanics. The report argues that this rally is being driven by something it calls forced greed. This isn't people buying stocks because they feel good about the future. It's mechanical buying. You have traders who bet against the market getting squeezed, and they're forced to buy back shares at higher prices. You have corporations buying back their own stock in record amounts, and then there's this absolute speculative mania in zero-day options, a kind of extreme short-term betting. But the most powerful force of all is something called the gamma wall. Right now, there is a massive wall of options contracts sitting between 6,800 and 6,900 on the S&P 500. And this wall acts like a giant magnetic bumper. As the market gets close to it, it triggers automatic buying from dealers, which shoves the market right back up. It's literally an artificial floor holding this entire rally together.
So, let's recap. We have a market that looks fantastic on the surface, but is incredibly fragile underneath, propped up by a combination of AI hype and weird mechanical forces. So, knowing all this, how would a professional investor even try to navigate this bizarre environment? Well, the report lays out two very different paths forward.
And this lays it out perfectly. Scenario A is the bull case, the AI supercycle. This is what happens if geopolitical tensions calm down and oil stays below $95 a barrel. In that world, the AI boom just keeps on rolling, and you'd want to own things like data center stocks. But scenario B is the bear case, a stagflationary shock. If the conflict in the Middle East blows up and oil spikes over $110, inflation comes roaring back, and you'd want to be hiding out in defensive, high-dividend stocks.
But before we finish up, the report has one final and kind of chilling warning, a black swan risk that almost nobody is paying attention to right now.
The real tail risk here isn't a recession or another war. It's what the report calls a cardiac arrest of the financial system itself. That liquidity cliff we talked about, combined with this wild mechanical options market, well, it could create the perfect storm for a sudden, violent flash crash that comes out of nowhere. And ultimately, the report leaves us with this really powerful metaphor. The market right now feels like a glamorous party. Everyone's having a great time. But it's a party that's happening in very shallow and rapidly drying water. And when that music finally stops, the result could be absolutely brutal. Which, of course, leaves us with the final question. Is the music about to stop? According to this report, the one thing to watch tomorrow is the earnings reports from the chip makers that power this entire AI revolution, companies like TSMC and ASML. If their numbers show even the slightest crack in that AI growth story, the whole narrative that's propping up this market could crumble, and we might just find out exactly how shallow the water really is.